Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today, we're looking at applied materials.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And before we really get into the mechanics of what this company is actually doing, I want to quickly mention a useful chart tool for investors and traders. If you want help, reading trading charts more clearly as you research these massive market moves, you can check out VIP Algos. The link is right below in the description.
Okay.
It's basically a TradingView indicator suite. It gives you visual buy and sell chart alerts, trend direction tools, support and resistance zones, and take profit and stop loss planning areas. It works across stocks, forex, crypto, gold, indices, futures, all of that. But just remember, VIP Algos is strictly an educational chart analysis tool.
Yeah, important distinction.
Exactly. It is not financial advice. It does not place trades for you, and it absolutely does not guarantee profits. Trading always involves risk, so manage your risk and do your own research. Also, that is an affiliate link, so we may earn a commission if you use it at no extra cost to you.
Awesome. So jumping right in, we have to talk about the sheer momentum playing out right now. Because the story unfolding here is, well, it's basically rewriting how the market prices infrastructure. If you've been watching your portfolio over the past year, you've seen this stock deliver a staggering 218% return.
Which is just incredible.
It's massive. But what really caught everyone's attention happened recently. They suffered this severe 10% sector shock, and then almost instantly they pulled off this massive, violent V-shaped recovery. I mean, the underlying demand for these shares is just undeniable.
It really is. It's a perfect illustration of how the market is, completely rethinking what this company actually is. Historically, people viewed equipment vendors in this space as, well, highly cyclical.
Boom and bust, right?
Exactly.
Mm.
But that narrative is shifting so fast.
Yeah.
The market is waking up to the reality that this isn't just some semiconductor tool provider subject to the usual cycles anymore. It is the foundational bedrock of the entire artificial intelligence infrastructure supercycle.
All right, let's move into the wealth building context because, when you're structuring a long-term portfolio around AI, everyone is desperately looking for the safest entry point into what is a very volatile tech landscape.
Oh, totally.
So how does this transition from a cyclical equipment vendor into, a structural growth compounder actually hold up under scrutiny?
Well, it holds up because the underlying demand dynamics have fundamentally decoupled from those legacy cycles. If you look at the past few decades, semiconductor equipment sales were tied directly to consumer electronics.
Like smartphones and PCs.
Yeah, gaming consoles, all of that.
Yeah.
The industry would go through this massive build-out to support a new phone launch, flood the market with consumer chips, and then demand would inevitably drop off once everyone upgraded.
And equipment sales would just crater.
Exactly. Incredibly cyclical. But the AI revolution has completely shattered that historical pattern. The capital expenditure we are seeing today, it isn't dependent on whether consumers are, buying new smartphone this year. It is a massive infrastructural arms race. And because of that shift, they currently have a rare 8 quarters of forward demand visibility.
Wait, 8 quarters. So you're saying that for the next 2 full years, they already know the precise demand for their multi-million-dollar machines is locked in.
Yep, locked in.
That is an incredible degree of certainty in a market that usually operates, quarter to quarter?
Right. It completely changes the risk profile for an investor. It shifts the stock from being a volatile tech trade to a structural foundational hold in a portfolio.
Which makes this the ultimate picks and shovels play of the AI gold rush. I mean, you have hundreds of companies out there right now burning billions of dollars fighting over which AI software will win.
Or which consumer application will dominate, yeah.
Exactly. The speculation there is massive, and frankly, a lot of those companies are going to fail. But to build those applications, you need massive data centers. To build the data centers, you need specialized AI chips. And to build those chips, you literally need the physical, highly complex systems that Applied Materials manufactures.
They are selling the literal tools required to dig the gold.
Right. So for someone looking at their portfolio, this isn't a short-term speculative bet on a new app.
No.
You are investing in the foundation of the technology itself.
Now, let's look at the fundamentals.
Yeah.
Because you're right, the thesis makes sense conceptually, but we really have to see if the financial reality supports the story.
And the financial acceleration here is moving incredibly fast. I know the revenue numbers are huge, but just how much growth are we talking about for the remainder of this cycle?
The numbers are massive. For fiscal Q2 2026, they hit $7.1 billion in revenue, pulling in a record earnings per share of $3.51. But the forward projections are what really validate that structural growth narrative. They generated roughly $28.4 billion in full-year revenue for fiscal 25, and consensus is firmly pointing to $38 billion by fiscal 27.
Okay, wait, I have to admit some confusion here, or at least a need for clarification. Going from 28 billion to 38 billion in 2 years, that's a massive 21% acceleration on an already massive base. What is physically driving that volume?
A huge chunk of this is their advanced packaging segment. So we know that the traditional method of scaling, which is basically cramming more and more flat transistors onto a single piece of silicon, it's running into the hard limits of physics.
Right, the chips just get too hot.
Too hot, and the electrical interference gets too high.
Yeah.
So the industry is aggressively moving toward advanced packaging. This is where they manufacture different specialized chips separately and then stack them together, vertically and horizontally. They connect them so tightly that they function as one single superprocessor. And because this requires incredibly precise new manufacturing steps to connect those microscopic layers, that specific advanced packaging segment is poised to grow by more than 50% in calendar year 2026 alone.
That makes perfect sense. But, growth is only valuable if nobody else can easily steal your market share. For a long-term investor, we have to look at the competitive quality of the business.
And their competitive moat is, well, it's essentially insurmountable right now at the leading edge. To really grasp this, you just have to look at two specific processes: physical vapor deposition, or PVD, and chemical mechanical planarization, CMP.
Okay.
They command over 50% of the global market share in PVD and over 60% in CMP.
Let's briefly explain the mechanics of those processes, because I think understanding how they work explains why they're so dominant.
Absolutely. So PVD is the process of depositing incredibly thin films of conductive material onto a silicon wafer, literally atom by atom.
Atom by atom. That's insane.
It is. You can think of it as like molecular spray painting inside a hyper-controlled vacuum.
Right.
CMP, on the other hand, is the process of microscopic polishing. After they lay down a layer, they have to sand the wafer down so perfectly flat that the variance is measured in the width of a few atoms.
Unbelievable.
As chip makers shrink their designs down to 2 nanometers and below, these proprietary vacuum and deposition systems become functionally irreplaceable. The precision required is just so extreme, and the failure rates at that microscopic level are so financially punishing that a fab plant can't just swap in a cheaper competitor's machine to save a few bucks.
The structural switching costs are just astronomical.
Exactly.
This brings up an analogy I love for where the industry architecture is heading right now. Chip makers are shifting to 2 new design standards simultaneously: gate-all-around architectures and backside power delivery.
Right. Huge transition.
Yeah, with gate-all-around, they're basically turning flat 2D transistors into 3D structures to control the electrical current better. And with backside power, they're completely rewiring the microscopic power grid to the bottom of the chip rather than routing it through the top where it causes congestion.
Yep.
Because these shifts require entirely new deposition and polishing steps, the company sells separate machines for both upgrades. It's literally like owning a toll booth on a major highway, and suddenly new legislation passes saying you get to charge for both the front axles and the back axles of every single car that drives through. It's a double dip on revenue from the exact same fabrication plant upgrade cycle.
And that dual tailwind is throwing off an incredible amount of cash. They have built this fortress balance sheet that allows for textbook capital allocation. Over the past 12 months alone, they've returned roughly $4 billion to shareholders.
Wow.
Which represents about 86% of their free cash flow. That aligns perfectly with their stated target of returning 80 to 100% of free cash flow.
But they aren't just coasting on buybacks to inflate the stock price, right? They are actually funding the physical expansion required to keep up with that 8-quarter backlog.
Precisely. They are aggressively funding the future. They're building a $500 million campus in Singapore to double their advanced cleanroom capacity, and they are sinking $5 billion into the UPIC Center.
$5 billion.
$5 billion. It's a massive R&D facility in Silicon Valley. They are spending heavily to ensure that impenetrable moat stays impenetrable.
That brings us to the catalyst timeline. If they are dropping $5 billion on research and development, we need to know when those investments start showing up on the tape.
The first immediate trigger you want to watch is the fiscal Q3 2026 earnings, expected in mid-August. Management has already put a flag in the ground, explicitly guiding that their core semiconductor equipment segment is on track to grow by more than 30% in calendar 2026.
So this upcoming earnings report is going to be the ultimate litmus test.
Exactly.
Yeah.
The market will be analyzing every forward-looking metric to see if they're tracking ahead of that highly aggressive schedule.
And looking just past those earnings, you have that $5 billion Epic Center becoming operational in the fall of 2026. What's crucial to understand here is that this isn't just an empty laboratory they built on spec. They have already secured critical binding innovation partnerships with the absolute giants of the industry.
Right, TSMC, Samsung, SK Hynix.
Exactly. When you have the biggest chip makers in the world literally co-developing next-generation tools inside your own facility, it completely locks them into your ecosystem. It acts as a continuous catalyst for new product announcements.
But the true catalysts driving the overarching narrative are the massive macro tailwinds. The hyperscalers, meaning the massive cloud providers running these AI models, are dropping over $600 billion on AI infrastructure this year alone.
$600 billion.
Yeah, and that capital has to flow through the supply chain, and it inevitably funnels right down into capital equipment names. Plus, we're seeing a critical easing of geopolitical tensions, specifically the recent cancellation of planned military strikes on Iran and stronger signals of stability in the Middle East.
Now, geopolitics might seem disconnected from a Silicon Valley tech stock, but
You have to remember the semiconductor supply chain is intensely global. Any de-escalation of conflict removes a massive risk premium that quantitative models typically bake into global manufacturing and shipping stocks.
wait, hold on. Let me push back a bit on that hyperscaler spending. $600 billion is a massive amount of capital, absolutely. But isn't that already on the front page of every financial site? We see the massive CapEx numbers everywhere. So if the market already expects this flood of spending, isn't that completely baked into the stock price today? I mean, if the market expects absolute perfection, even a slight delay in a single fab construction could cause a severe reaction. We really have to stay grounded here. Catalyst is only powerful if they surprise the market to the upside. If they just meet expectations, it might not move the needle the way people hope.
That is an exceptionally valid point, and is exactly why understanding the precise timing of how that capital is deployed is so critical. The market might know the $600 billion is coming, but they don't know exactly when the revenue will be recognized, which we will address when we look at the execution risks. Now let's pivot to the chart, because we have to look at how the market is actively pricing all this right now.
And looking at the price action and momentum, it has been nothing short of explosive. We teased it earlier, but the mechanics of this move are just fascinating to break down.
The stock recently closed at $552.64. To put that momentum into perspective, it surged 11.19% in a single trading day.
One day.
And is up 28.16% over a strict 30-day window. But what's crucial to analyze here is the structural integrity of that movement. We saw a remarkably potent V-shaped recovery. On June 5th, the stock suffered a severe 10% drop driven by what the market is calling the Broadcom shock.
But what stands out to you as an investor isn't the drop itself, it's the market's reaction to the drop. That 10% dip wasn't some slow bleed where buyers stood away and lost faith. It was aggressively bought up by the market almost instantly.
Instantly. Yeah.
The stock firmly reclaimed its psychological support levels within days. When a stock takes a double-digit hit on broader sector news and then violently snaps back to new highs, it tells you a lot about the underlying pent-up demand for shares.
It tells you institutions are basically waiting for any excuse to buy. And that one-year return sitting at over 218% is not just retail investors buying a few shares in their brokerage accounts. That kind of sustained vertical movement is driven heavily by algorithmic momentum flow. Quantitative trading systems lock onto the upward momentum. They verify the fundamental data, including an impressive 7-for-7 earnings beat streak, and they just chase the trend. Institutional capital is essentially being forced into these bedrock AI plays so they don't underperform their benchmarks. The chart structure is showing a renewed re-rating phase as the price presses right through the median analyst targets. It's the technical validation of the fundamental story we just outlined.
So what does market sentiment look like? If institutions are actively chasing the trend, we need to know exactly how the big money is positioning.
Unsurprisingly, the overall narrative on Wall Street is overwhelmingly bullish right now. After that 10% Broadcom-induced sell-off we just discussed, major players like Citi stepped in almost immediately, naming it an attractive buy. They explicitly noted that AI is rapidly transitioning from a software speculation story to a hard capacity story for the entire physical supply chain.
And when you look at the broader analyst consensus, it is heavily skewed to the upside. Out of 40 analysts covering the stock, 32 rated a buy or outperform.
Mm.
You have firms like Cantor Fitzgerald pushing their price target all the way up to a high of $650, citing a massive multi-year supply-constrained upcycle.
But it's not just analysts throwing out aggressive price targets. The actual institutional conviction backing those targets is rock solid. In the first quarter of 2026, 138 different hedge funds held the stock.
Oh.
And one of the main reasons for that institutional stickiness comes down to their services segment, Applied Global Services, or AGS. This provides immense stability to the balance sheet.
Right, because selling a multi-million-dollar machine is a great one-time revenue hit, but securing the contract to service it generates predictable, recurring cash flow for years.
It's exactly. 2/3 of their AGS contracts are multi-year agreements, and they boast renewal rates consistently above 90%. For a hedge fund manager assessing risk, that recurring high-margin revenue acts as a massive magnet. It cushions the blow if equipment sales ever experience a temporary slowdown. It's sticky, long-term capital anchoring the stock and preventing those Jeep sell-offs. Now let's talk about the risks, because, no thesis is without its vulnerabilities.
And this is where we really need to lean into the caution. A 218% run does not happen without generating some significant quantitative red flags. Right now, the trailing PE multiple, the price-to-earnings ratio, has stretched all the way up to between 46.2 and 46.96 times earnings.
Which is high.
That is a 10-year high for them. Historically, when an equipment manufacturer hits a multiple approaching 50, it flashes stark overvaluation signals on quantitative models. The absolute risk here is that the stock is priced for flawless execution. If they stumble even slightly, or if a single quarter misses the whisper number, a 46 times multiple compresses violently. You really have to ask yourself, are investors paying tomorrow's perfect prices today?
That valuation risk is very real, especially when you consider how high expectations are. But there's also a deeply physical execution risk tied directly to logistics. Management has actually confirmed that their current revenue growth isn't bounded by a lack of demand. The customers desperately want the machines.
So what's the holdup?
The bottleneck is supply chain transit times for incredibly specialized high-precision components. And more importantly, clean room space availability is a massive bottleneck across the entire industry. You can't just put these multi-con vacuum systems in a standard warehouse. They require ultra-pure fabrication environments that take years and billions of dollars to build.
Right.
If the physical infrastructure of the fabs can't be constructed fast enough to house the machines, the revenue gets deferred to later quarters, no matter how high the demand is.
And that deferred revenue leads directly to the biggest medium-term risk on the horizon, the 2027 air pocket. The industry is building fabrication plants at an unprecedented rate right now to handle these AI workloads. But there is a very real risk that the current wave of fab buildouts finishes before the tech giants make their next round of capacity decisions.
Yeah, that's a huge factor.
Think of it like building a massive subdivision of houses. If the construction crews finish building all the homes before the city approves the next zoning permits, all those highly paid workers are suddenly standing around with nothing to do. If the tech giants hit pause for even a couple of quarters to evaluate their AI needs, that equipment demand drops instantly. And if that 2027 air pocket materializes, the investors paying a 46 multiple today are going to feel a tremendous amount of pain. So with everything on the table, what's the final verdict?
When we weigh the fundamental transformation and their practically insurmountable competitive moat against the very real valuation and supply chain risks, the final bullish score lands at an 8. The analytical stance here points to a multi-year hold, specifically looking at a 1 to 3 year horizon.
Okay.
The primary objective is to capture the wafer fabrication equipment supercycle, which is aggressively projecting to head toward a $250 billion market, while the company's own profit margins extend past 30%.
It really is the ultimate picks and shovels play for the investor who wants bedrock AI exposure rather than fleeting software speculation. But to be perfectly clear, we're not telling you to buy, sell, or hold anything. That premium valuation means conservative or deep value investors should tread very carefully. Keep in mind, this is just an analysis of market probabilities based on current data. It is absolutely not financial advice.
Right, never buy or sell a stock based solely on this information.
Exactly. The landscape changes quickly, so always align your choices with your own risk tolerance and investment timeline. And hey, if you want a cleaner, more visual way to read trading charts as you do your research, check out VIP Algos through the link below in the description. VIP Algos is a TradingView indicator suite with visual buy and sell alerts, trend direction tools, support and resistance zones, and take profit and stop loss planning areas.
It's super helpful.
It really can help make charts easier to scan. But remember, it is still only an educational chart analysis tool. It is not financial advice, it does not place trades for you, and it does not guarantee results. Trading involves risk, so always do your own research and manage your risk. This is an affiliate link, and we may earn a commission at no extra cost to you.
And if this discussion helped you navigate the market today, please subscribe, like, and comment underneath. We'll see you for the next Smart Wealth with Joshua Analysis.
As you watch the markets this week, ask yourself, when everyone is rushing to build the future, who owns the factories making the bricks?